we think that you really ought to be trying to invest, not just based on momentum, but based on actual fundamentals of the companies that you're investing in.
Joe, Steve, let's talk about the Mag 7 today. Seven stocks that make up about a third of the value of the S&P 500. Mag 7 is lagging behind the market so far this year. Goes to something we've talked about many times, that it's dangerous to have a few stocks that make up that big a portion of the index. So based on 2025 results, Joe, is it any more concerning than it's been in the past?
Is it any more concerning than it's been in the past that what that it
That
did
the
that
Mag 7, I mean, it's lagging the market, which is driving the index down, which is the reason we haven't owned the S&P 500 in a long time.
well, look, there's a couple of reasons why we haven't owned the S&P 500. We think there's better ways to do these things. Cap weighted index, capitalization weighted indexes, which means that you weight the largest companies the most. It kind of makes sense, but it's basically a momentum portfolio, right? The things that are doing well continue to do well. We know that momentum exists in markets, and so that is one way to take advantage of it is with a cap weighted index. But what happens is you end up with these, in this case, these seven stocks, and it's really the top 10 if you look at the S&P 500. I'll have to look at some of that. I'm not sure. It's about a third of the index basically is in the top 10. So, we don't do that because we look at those top seven stocks and we're not crazy about the valuations. And we think that you really ought to be trying to invest, not just based on momentum, but based on actual fundamentals of the companies that you're investing in. In other words, we're trying to actually invest rather than just chase performance. Unfortunately, a lot of the world is just chasing performance. And so the more people chase performance, the better they do. So, if you think about the Mag 7, we're not talking about bad companies here. This is Apple, Microsoft, Alphabet, which is Google, Amazon, Nvidia, Meta, which is Facebook, and Tesla. And out of those, when you really start looking at it, the one that, I don't know, I know that Tesla was performing poorly recently or previously, but it has recovered some recently. But I mean, those are just some really expensive stocks. You look at Apple, which, by the way, full disclosure, we own some Apple. We just don't want to own it in the quantities that it's owned in the S&P 500. And we have people that have owned Apple for over a decade. We keep trimming the position because it gets too big. That's part of being prudent about how you manage your portfolio. We also have clients that own Microsoft. Same thing. We've had Microsoft in various portfolios since 2013, but we don't want to have our entire portfolio dependent on those stocks. By the way, we also have various clients who own Alphabet and Facebook too. We don't, if we own the Nvidia, it's a tiny amount, and it wasn't bought at our behest. It was bought by a client, and we don't own any Tesla. So when we look at these things, again, like I said, the problem we have with the S&P is that you get too much in those stocks. It's not that they're bad companies. They're good companies. Apple, just to take that example, listen, I'm an Apple fanboy here, man. I've got a Mac sitting over here. I'm wearing an Apple Watch and I got an iPhone. I love Apple. I think it's a great company. I think their products are great. But they haven't had new things come out in quite a while. They're really highly dependent on the iPhone at this point. A lot of the people that we have that own Apple, they've owned it so long, they've got big capital gains, and there's a problem, a tax issue there, put it that way. Anyway, it's underperforming this year. What does that mean? When you look a little bit broader, the difference in performance isn't that great when you look at, for instance, value versus growth. S&P 500 value is up about 1% this year. S&P 500 growth is down about 0.6. So, we're not talking a huge spread here. Look, I think the big news in the markets is not this growth versus value or Mag 7 versus the S&P or versus anything else. I think the big news here is U.S. domestic versus international. That's where your gap is. And actually, there's some things performing that I think nobody expected. Look at Latin America. Latin America is actually one of the better performing regions this year. Year to date, Latin American stocks up 20%, Europe's up 21%. those were not on anybody's radar. So we can talk about the difference between a 1% difference between the Mag 7 and the rest of or the S&P 500 growth and the rest of the S&P 500, but I just don't think it's worth all that much. Put it that way.
So, Steve, based on what Joe said, how are you looking internationally?
Yeah, well, I think just because those seven stocks represent such a large portion of the index, well, there's a couple of things there, but one is that has been a recipient of a lot of those foreign flows, and that could suffer disproportionately when you have a reversal of those foreign flows. So I do think it matters in that regard. It's directly linked. And I think that's been a part of a driver for that margin expansion you've seen in those valuations getting pretty lofty. And historically, there's not a good precedent around getting that kind of concentration. You can look back at the 2000 market where you got quite a concentration in tech. You can look at the great bull market that preceded that with the Nifty 50 when you're getting kind of before my time, admittedly, but the largest US stocks were getting quite a few fund inflows and became a disproportionate part of the index, and the capitalization went really high. To me, one of the interesting points here is that some of the sell-offs seemed not so much around tariffs, but around the DeepSeek announcement that came out of China. And part of these stocks and their lofty valuations, part of it did get tied to artificial intelligence and the expectation there that these companies that have this enormous capital spending power could basically buy their way into AI leadership. And with that DeepSeek announcement that came out of China, one of the takeaways was there is that AI might actually be commoditized to a degree that that announcement seemed to suggest that you could spend quite a bit less and get most of the performance in these large language models. And I think that, along with some other developments, has also kind of shaken some of the thesis around these stocks. We've seen Microsoft, I think Amazon too, pull back on some of their data center spending. Last year was all about, we're going to spend $500 million, we're going to spend $1 billion, we're going to build out AI. And then this year you started to see some pullback there. I previously pointed to the IBM survey that found only about 15% of companies reporting that they're getting company-wide benefits out of integrating AI. And I've always been dubious that this time is going to be different in that you're going to have a major technology transition that is going to happen almost overnight, and also a disruptive technology that's not going to be disruptive. That these leaders will remain the leaders, and it will just enhance their leadership. And that also got shaken with stuff like Apple talking about in the future. It might move to AI assisted search rather than depending on Google, and that could be a threat to its leadership. So, and then of course you've got the stuff that's been coming out with Apple in terms of it having to also transition away from its strategy that was so China dependent. But all these things I think it kind of points to that when you're priced to perfection or when your multiples are this high, you start getting into dangerous ground where any changes in the narratives can lead to underperformance. And I think that's some of what we've seen go on this year, is that these valuations don't give much room for any sort of weakness or problems. And we've seen some weakness and problems start to pop up, or at least the potential for it.
So, Joe, have investors become so focused on the S&P and the Mag 7 that it's made them blind to the bigger investment picture?
Well, yeah, but I mean, the question is when are they going to open their eyes? I think that it's really interesting to see, to think about these companies, the Mag 7, look, let's be honest, they're good companies. They have big profit margins, right? So are they just always going to have big profit margins? Isn't that kind of contrary to what we expect from capitalism? Shouldn't big margins be competed away? Isn't that what's happening with DeepSeek and people challenging Google, for instance, on search? Now, look, Google's not going to lay down and just say, "Oh, fine, take it." Okay, that's 90% of our revenue. We're not going to fight for that. They're going to fight for it. My point is that when you have big margins like this in these companies, they do get competed away unless there's some impediment to that. What's the impediment? Well, we do have this This administration and the previous administration have both had aggressive, antitrust type policies to try to break up some of these big companies. They haven't been successful. Let's be honest. They just haven't. Even you go back to the 90s and look at the Microsoft case. Ultimately, Microsoft became stronger because of what happened to them with it was the browser, I think, that was being included in the operating system. So my point is that it's very difficult for governments to break these things up, but eventually the market works, and these things will get competed away. Look at NVIDIA. Listen, NVIDIA a few years ago, 5 years ago, was a company that made chips for video game makers. Wasn't that big a deal. It wasn't some global dominating company. It innovated and it became that company. So other companies are going to do that too. Companies that we're not talking about today, they're going to be in the top 10 tomorrow. They're going to be in the Magnificent Seven or the Wonderful Seven or whatever the heck it turns out to be called. But again, I want to come back to that idea though that you want to try to invest. Listen. Maybe I'm an old-fashioned guy, but I think that investing matters, and I think what you pay for stuff matters. So when I look across the globe right now, I see, just to compare Europe, I compare Europe to the United States. We've got almost exactly the same expected earnings growth, long-term earnings growth, but you pay 21 times earnings for the S&P 500. You pay 13 times earnings for Europe. You pay 15 times cash flow for the S&P. You pay 8 times cash flow for Europe. I'm not saying that Europe has better companies or whatever, but when you look at it, really, the earnings growth is about the same. So what are you paying for when you buy these Magnificent Seven or you buy the S&P 500 versus buying the Euro 350? I don't think you're really picking up all that much as far as actual value. When will that value be realized? Well, I can't tell you that. I really don't know. It means that other people are going to have to recognize it. I think that's starting to happen now. And part of that is, by the way, most of that in a lot of ways is on the foreign investors who have come to the United States and said, you know what, we got to own these things. And now they've got this huge, huge overweight to the U.S. And by the way, they're not hedged against the dollar risk. The vast majority of it is not. And so if the dollar starts to fall, they've got a bigger problem than the U.S. investor has, because not only will they lose on the stocks, they'll lose on the currency too, because they're measuring their performance in euros. So, like I said, I don't know when, or maybe we're at the beginning of a shift here where we're going to see international outperform, but we got to see the dollar go down for that to happen. In general, that's what usually happens. So I don't know. Like I said, I'm not too concerned about the Magnificent Seven. I'm not focused on them. I think they're interesting companies. We own some of them. We don't want to own tons of them because we do believe their big advantages will get competed away or innovated away, one way or the other. That's the way it always works. Look, there's kind of this idea, I think, in investing where you can either buy the guys that are leading and say that they're going to keep leading, or there's the idea that you can try to find the ones that are going to lead in the future, or you can find the ones that are very cheap because of some reason that you think can be fixed, because of some problem that you think can be fixed. That's value investing. We're more on the value side than the growth side or the momentum side. We do look at momentum. It's part of what we do, but it's not the main thing. I think you got to marry momentum with fundamentals. That's what we try to do.
All right. Investing always requires information, and we've got lots more. Don't forget to sign up for our free newsletter.